if you can't raise money as a private company because you don't have anything investors are interested in, you're certainly not going to raise money as a public company just because you have a stock symbol. The best scenario is somebody who's already been involved in a publicly traded company that understands the basic process, and then I just have to kind of fill in the dots of what method are we going to use to take the company public.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel.
Hi everyone, welcome to The Path to Wealth. I'm your host, Hannes Henschel. Today we're talking with Dr. Michael Brette, JD, about his journey from law school to the financial industry and how he became an expert in raising capital and asset protection. Dr. Michael is the founder, president, and CEO of Small Cap Equity Advisors. He has been a Juris Doctor for more than 40 years and the author of 2 books, Asset Protection Planning and Raising Capital for Your Business. He's appeared on over 700 radio and TV shows discussing business and financial topics. He's also a passionate musician and a music producer. Michael, thank you so much for coming to the show today. Our listeners will love hearing about your story and the strategies to succeed in the industry.
Yes, thank you for the opportunity.
So, Michael, let's get to the beginning. What brought you into the financial industry and why did you choose law?
Why I chose law was an attorney that I knew pretty well, F. Lee Bailey, who since has passed away. But when I was a young guy, I followed his career and I liked what he had done to help people, and so I went to college, majored in philosophy and political science, pre-law, and then went to law school. And, how I got into the financial area is kind of a long story. I wrote the book, as you mentioned, Asset Protection Planning, and I did a lot of trusts and partnerships and corporations for business owners. And they started asking me, can you help us raise capital or go public? And my answer was yes. I always tell people yes, and then I figure out a way to do it. So, I kind of segued from the asset protection area into doing private placements, reverse mergers, and, assisting companies in going public or doing the offering documents and putting them in touch with investment banks so they could raise money. So that's kind of how I got into both areas.
Yeah, very nice. So what do you say is one of the biggest challenges in the current environment for companies that want to go public? Is it the regulatory environment? Is it the challenges of understanding how to go through the process for the founders? Because I founded multiple companies, and as a founder, for me, it's always been a challenge to get on the same page with my lawyers. How do you usually go about holding hands in the process and guiding the founder through the process? And what is the biggest challenges that you find in working with the founders?
Yeah, that's a good question. The biggest challenge I find is a lot of people who contact me to go public don't understand the process, and they don't understand that it's a very expensive process in terms of time and money. That's one of the biggest hurdles. For some reason, there's this myth that's been circulated out there for years that a company that has no revenue, that's basically an idea, can go public and raise millions and millions of dollars because they're a public company. And that's simply not true. What I tell people is, if you can't raise money as a private company because you don't have anything investors are interested in, you're certainly not going to raise money as a public company just because you have a stock symbol. So it's an educational process to walk people through. the best scenario is somebody who's already been involved in a publicly traded company that understands the basic process. And then I just have to kind of fill in the dots of what method are we going to use to take the company public. Is it going to be a reverse merger into an existing trading company? Is it going to be through an S1 direct registration with the SEC? So then we start going through, the method of going public and then putting all the pieces together, which is legal, accounting, investment banking connections, road shows, and then, start mentioning all the elements that are part of taking the company public. Very few companies want to take the time and go through the expense once they learn the process. But, for some companies, if you really have revenue, which is the generator for your stock, as opposed to a startup, if you have some revenue and some intellectual property, the door is open for you to go public and be successful.
Would you say that the sentiment, especially given where we are in the current market overall, has changed, given that I always look at the last 10 years plus as kind of the golden decade we've experienced at least in my lifetime, where, money was cheap, private equity firms and venture capitalists were very eager to place large bets. But all of that has shifted. And you mentioned it that, you cannot just have an idea. You need to actually have revenue. There needs to be a valid business. Would you say that is more so the case right now where, you just need to have a sound business case to even attract capital?
Yes, exactly. Again, whether you want to stay private or you want to go public, you have to explain to investors or investment banks why they should invest in your company. Again, whether you stay private or you're public, you have to answer that why question. And a lot of people, they get tied up in their technology. They want to say they're disruptive with their technology, but yet they don't have any sales or revenue. So how can you be disruptive in your technology when nobody's paying you for the technology? And then you hear the comment from people, well, we're a unicorn. Well, no, you're not. A unicorn is somebody who's got $1 billion valuation. You don't have $1 billion valuation, so you're not a unicorn. So, the determining factor of whether somebody can be successful in raising capital from investors is to give the investor a reason to answer that why question. In other words, they want to know if they invest in your company that they're going to make money. Everybody knows there's not a guarantee, but if you lay out a plan and don't focus so much on your brilliant idea, but focus on the revenue that you currently have and how investors are going to benefit from that, then your job is easier at raising capital. Again, whether you're a public company or a private company. But investors only invest to make money. They don't really, aside from all the things you might hear in the mainstream news today about everything else under the sun of why investors invest, the bottom line is investors invest to make a return on their money. And again, as an entrepreneur or a late stage or an established business, you need to walk the investor through, because in this environment, even though, the stock market's up and down and things of that nature, the investors are still looking for good ideas to put their money. I mean, cash sitting on the sidelines really doesn't do anybody any good. I mean, you can't save yourself to wealth. You have to make investments. So, there's a lot of money out there, to put into deals, but investors are picky and they have a lot of ways that they could go to use their money to get a return. And I tell some people, I get contacted a lot by startups, again, pre-revenue startups ideas. And I just tell them, an investor can put money in the stock market, even though it's up and down, and make money. Why should they put money into your pre-revenue startup when you have no track record, no sales, nothing, and take a risk. So it's an educational process on both sides, but there's plenty of money out there, even in this environment. You just have to know where it is and then how to attract the capital and the investors.
So what segregates the successful founders in this process that are able to actually attract that capital from, I would say, probably the majority of founders who are not able to attract capital, especially in the current environment? Who is able to go where you said the money is right now?
Well, I mean, the biggest factor, I mean, I've been doing this for 30 years. And what I found that investors want to see, they want to see a successful track record of the management team, of the founders. Have you been here before? Have you done it before? Have you taken a company from zero to a publicly traded company? Do you have a successful management team that can execute the business plan that you're presenting to me? That's really what investors are looking at, because they're going to put $100,000 or more in your company. They have to feel confident that you, as the entrepreneur, can run the business and execute on your plan and do what you say you're going to do to give a return to the investor. That's number one. And a lot of that can be answered by the founders, again, past experience, past success, even past failures, just to show investors you've been there and you know the process. You're not somebody just out of business school, and so again, establishing yourself as a successful founder is probably the number one reason why companies succeed or fail in raising money.
Yeah, you mentioned that even past failures still build credibility. Would you say that there's more hesitance to go with a founder who has maybe failed, or at least, if he can speak to, okay, this has been the situation, this is why, but we took a sincere shot and I think we can do better this time?
Yeah, I mean, that's a possibility. And again, if you can explain, in other words, if you are the founder who mentions the failure, have a reason for mentioning that and answering the question, how you failed, why you failed, and why you're going to succeed this time. I mean, J.C. Penney, when he founded the Penny Store, he filed bankruptcy 3 times before he made a success out of himself with his chain. So, failure is just a step towards success. And if you can explain, and again, not focus all your presentation on the past. You have to focus on the present, with investors. But again, figure out why you failed, explain it, and then move on.
Yeah. Are there some traits that when you have the conversation with the founders, and then when you go through the process, obviously you are also very engaged with them over a longer period of time, so you really get to know them. What separates the successful ones from the not so successful ones? The
main step for success is understanding there's no guarantee that you're going to be successful in raising money. Raising money is a lot of hard work. It's expensive. It's time consuming. And if you as the founder don't have the necessary money to do the offering documents to file with state and federal regulators, if you don't have the time that you can devote to the process, raising capital is a full-time job. It's not something you can do part-time. And investors don't want to hear from a spokesperson for the company. They want to hear a presentation from the CEO, the president of the company, and that's the only person they really want to hear from. So the step to be successful is being able to commit the time, the money, the resources to be successful. And that's your first step right there.
Yeah, 100%. I think anything in life, what we want to be successful, we have to be fully involved.
Absolutely. As I mentioned, raising capital is a full-time job. I mean, I get calls and emails from people that are working a job someplace else and wanting to start a business. I mean, that's admirable, but you've got to devote the time to the business you're starting to be able to meet investors, I mean, you can only do so much over the internet and Zoom and things like that. You really got to get out there and face to face with investors, both retail and institutional investors, explain your story, look them in the eye, shake their hand, and answer their questions in order to get them on your side. If you're working a job someplace else, I mean, how are you going to spend the time necessary to, get out there and meet investors and raise money? So, again, I get a lot of calls and emails, not to say that you can't do that. It's just very, very difficult given all the other hurdles, a founder has to jump over to raise money.
Yeah. So maybe you can help other founders understand the process a little bit of where you connect the dots between once they go through the compliance and the paperwork is in place, where you connect the dots and the actual capital connection comes in, and where that capital can be attracted from when you help them connect with the right entity.
Good question. Yeah, the first step, again, is, as you mentioned, compliance. There's only two legal ways anybody can raise money, and that's with a registration with the SEC or file an exemption from registration. The exemptions are Reg D, Reg A, and also the regulation crowdfunding that was passed under the Jobs Act. Those, the two methods, registration and exemption. Once you have the documents on file and you're given the green light by state and federal regulators, then depending on which offering you're using, let's take regulation CF, crowdfunding. Under that, once you file the Form C, which is a mini prospectus with the SEC, you have to upload all your documents, all your videos, and your information to an SEC-approved funding portal. You can't raise money on your own. You have to upload it to a portal, and then you have to have a marketing budget to attract investors to that portal so they can view your documents, click the invest button, and then a licensed broker picks up the call and closes the financing. That's the one. Reg D and Reg A, you can, as the issuer, once you have these documents filed and approved, you can raise money yourself. You don't have to go through the portal. The problem with that is 90% or more of companies don't have access to real investors. They don't, beyond their friends and family, they don't really have anybody they can go to. So they have to reach out to a professional like myself or an investment bank to be a lead banker and work through that process where the investment bankers make the introductions to their investors. I always tell people, look, go where the money is. The money is with family offices, investment banks, placement agents. They represent trillions of dollars of investment capital. If you're trying to do it on your own, you're more than likely you're probably going to fail if you don't get connected with the capital sources. Now, I'll give you an example. If you're trying to raise $1 million at $25,000 per investor, that's 40 investors. Doesn't sound like a lot, but most people, out of 100 people that only 4 people will actually write a check. So you have to get beyond your friends and family and people to raise $1 million or $5 million or $10 million or whatever the dollar amount happens to be. You have to have a wide audience. I mean, you have to present your deal to tens of thousands of investors online and in person before you get to the ones that are actually going to write the check.
Yeah. So how would you say has, for example, the ability to crowdfund changed the industry and has made the capital accessible for founders? And there's more of that coming. I think the industry is very much evolving in the online space. It's more and more so that out of smaller and smaller portions of capital, people do bring capital together. But what is your take on that, given that you have such an expansive history in the market? Yeah,
I think crowdfunding under the Jobs Act is the best thing that's happened to capital raising in 30 years. And the reason I say that is depending on which method you use, whether it's Reg A or Reg D or Reg CF, those elements give entrepreneurs and businesses the opportunity to advertise, market, and promote their offering to the general public using email, social media, radio interviews, television, podcasts. Whereas before, when I started 30 years ago, you could not advertise and market an offering. You had to deal with what the SEC called pre-existing business relationships, people you knew extensively, in order to solicit money. Today with crowdfunding, and I'm not talking about, like Indiegogo and Kickstarter. Those are more rewards based as opposed to equity investments. I'm talking about the crowdfunding like Regulation CF crowdfunding, Reg A and Reg D. Those are the ones that are raising billions and billions of dollars because of the Jobs Act and allowing companies to upload their offerings to these platforms, to advertise, to give seminars, to go to conferences, and expose their offering to the general public, within certain guidelines. That's where I see the benefit of crowdfunding. But having said all that, you would be surprised at how many people, entrepreneurs, startups, or even seasoned businesses don't understand what I just said about crowdfunding. They're out there with a deck or a business plan, contacting everybody under the sun, whether they're an investor or not, just helter-skelter sending out decks which are illegal. And they don't understand, they don't take the time to understand crowdfunding. And the reason that the SEC passed that crowdfunding act, the Jobs Act, was to make it easier for companies to legally access capital. But everybody that I talk, not everybody, but a lot of people that contact me, when I tell them about crowdfunding and what they do, well, it doesn't work. We tried it. All right, what was your marketing budget? How did you reach out to investors? Well, we didn't market. We just uploaded it to a platform and sat back and waiting for investors to invest in our offering. Well, that's failure right there. So it's a lack of understanding on the part of businesses on what the Jobs Act and crowdfunding can do and how to take advantage of it. I mean, it's there for the taking.
Yeah. Would you say that there is maybe a guiding number, a percentage that you think, let's say we want to raise $5 million, and what's a suitable marketing budget for that somebody should account for upfront?
Yeah, the percentage is 10% of the amount you're trying to raise is what you have to have set aside even before you contact your legal team to put the offering together. And you need 10%. If you're trying to raise $1 million, $5 million, $10 million, whatever, you need 10% because you have to produce videos. You have to send those out to investors, do social media posts. I mean, there's 10% is the kind of the figure that they need to have. A lot of people don't understand that. They pay a law firm to do the offering documents. They pay an accountant to do their financials, and they stop there. They think they can use unlicensed finders to go around soliciting money and pay them a success fee, and they don't have to spend any money on marketing. That's just wrong.
Yeah. Wrong and illegal.
Yes, absolutely.
So on a personal note, where do you think the term accredited investors is evolving to over the next couple of years? We hear that the SEC is working on the requirements for that. What is your assumption? What that term is going to mean for us in the next couple of years?
Well, investors are always looking for good deals. It doesn't depend on, the stock market or the economy. Investors have a lot of capital available. Whether they deploy that capital in your business or anybody's business comes down to what we talked about earlier. Why should I put the money out now and, make the investment? How soon can I get my money back and a return on my capital? So terms and conditions of offerings are subjective to a certain point. But, a lot of it comes down to valuation that the company has. Now, startups, you really can't do a valuation for a startup because they really don't have any revenue or anything like that. So it's kind of like guessing game. But established companies over the long haul can get an independent valuation. And the valuation is important because it determines how much you as the company are going to give up for the capital. And if you don't know a percentage of your business, I mean, you might give up 20% of your company for $1 million, which is really expensive money. So evaluation for somebody that's established is very important. So where things are going to go with investors, the SEC, it's just going to come down to quality deals, as it always has. I know there are some people out there that will invest $5,000 or $10,000 and think that if they spread that around between 5 or 6 different companies, maybe one will hit. I don't know anybody that's got that discretionary money that will do that. Serious professional investors, want to put in $100,000 or more. They're willing to wait long term to get a return on that. But again, it's up to the entrepreneur, the business owner, to convince the investor that if they wait 2, 3, 4, 5 years, what's the likelihood they're going to get a return on that investment? So again, it's an educational process all the way around.
Yeah. And what is your personal strategy? You've been exposed to the industry. You've been exposed to founders. Do you make those investments yourself?
I used to years ago, but I don't anymore. What we do is we look to small cap publicly traded companies because of the liquidity that a public company can provide us. So my partners and I will go into a public company if they have a Regulation A offering, and then we'll buy shares right out of their offering at a discount. And the reason we like the Reg A is that the stock is free trading. So once we make an investment, we can sell in the open market and get a return immediately or almost within a couple of weeks, return of our capital plus a return on our capital. Anymore, I don't, myself or my partners, we don't invest in startups or private companies. It's what we call dead money. I mean, you put money into a private company, there's no way for a liquidity event until, the founder either sells out or takes it public. So personally, my company and my partners, we focus on publicly traded companies. That's why we like to take private companies public, because if it's a solid deal, accessing investment banking capital, family office capital, there's a lot of that money available. So that's what we focus on. I do work with private companies, but it's to do their offering documents under Reg A or Reg D or Reg CF and get them to that stage where we can take them public.
Yeah. And for someone who is not at the source like yourself, how do they get access to that early stage in the public cycle?
Early stage capital, I mean, depending on how you define early stage, if it's seed capital, typically seed capital is $50,000 to $100,000. Somebody should be able to access their friends and family circle to get $100,000 and not reach out to investment banks. That's just too small. Then you go from seed capital to round A, B, C financing, which are larger dollar amounts. That's where you can go public and then start attracting investment banks and placement agents to access the larger amounts of capital. Seed capital, again, can be used. I mean, you can raise that from angel investors. Typically, angel investors are wealthy individuals that have $10,000 to put in as a seed round, and if you raise that from 10 people, you've got your $100,000. So seed capital, there are investors out there. They're really picky though at this point.
Yeah, definitely the transaction volume has gone down quite tremendously in the last 18, 24 months.
It has, and the reason is it's looked at from investors as just too risky. They can take that same $10,000 or $50,000 and put it in the stock market and wait it out, and eventually the market will turn around. They can get a return. Right now, putting that with unproven startups is just way too risky for a lot of people. They just don't believe the story anymore about a pre-revenue startup is going to be successful. 90% of startups fail in the first 2 years. So the numbers are not on the startup side. So investors would rather take a shot at something tried and true, a company that's got revenue, a company that's been around 5 years, that's proven themselves. Their investors have, even though there's no guarantee, investors feel they have a chance.
Yeah, definitely. Would you say a lot of that goes with the general sentiment? Like, again, pointing at the last decade, everybody was in a frenzy. It's just been a run that kind of hit a bump in the road now. So the overall sentiment has changed, and the transaction volume and the check size immediately goes down.
It does, and it's good that you mentioned that. The problem with the crowdfunding aspect is it's being pitched by certain platforms that a startup can put their offering on the platform and minimal investment of $500. Well, I mean, if you're trying to raise $1 million to $5 million and you're getting checks for $100 to $500, you're probably never going to raise the whole amount you're trying to raise. So the check size is smaller, but it's being pitched by people out there that, specialize in that type of financing that, hey, look, you can put your offering up on this platform and then you could spread it out between all these retail investors that could put in $100 or $500. That works if you're trying to raise a small amount of money, but it doesn't really work if you're trying to raise, some serious money. So, my advice to people is, work with a professional. And that's what I tell a lot of startups. Look, if you can't afford to deal with professionals to help you structure an offering, then you should not be raising capital from the general public, because it's just wrong. So again, I've mentioned before, it's an educational process. It's information. It's professional advice on what method to use to raise capital, how much money are you going to raise, what's your use of proceeds, what's your exit strategy. All those things come into play when you're raising money. And this check size that a lot of people are touting now, that you can raise money with people putting in $100 to $500, to me is just the wrong way to go.
Yeah. Also, if I look at the behavior, the retail market doesn't have the stamina to take what's going on, I would say, in the startup world or in the markets. Like, I think they very much go with the sentiment, and they don't have the cool to sit there like an institutional investor and look at the long-term potential of things in the same way.
Yeah, I think you're right there. And I think the main reason for that is the retail investor doesn't have the emotional stability to put up with all the things that are going on in the world today, between the economy, between politics, between wars and disturbances and domestic and international conflicts and things of that nature. A lot of retail investors are scared, and they make in my opinion, they make their investments based on emotion as opposed and on fear as opposed to facts. And I think that's what you're seeing now. Whereas the institutional money, whether it's private equity, family offices, investment banks, they look at the facts. They look at, the stock market is a projection of 6 months out or more. It's not today. Today, the market, could be up and down or, whatever. But professional investors look 6 months out or longer, whereas the retail investor doesn't. The retail investor is worried about their 401k going down. $100,000 for them is a lot of money. So they're making decisions, a knee-jerk reaction based on emotion and fear rather than facts. And I think that's what's going on today.
Yeah, certainly. I feel like if I look back at the last 24 months, whether it's the public markets or the private markets, when I just speak to founders and when I see the check sizes that are being dealt with right now, that all of that has changed, and the fear is definitely keeping things in place right now. So changing gears a little bit, one of my favorite questions is always like getting a little bit personal. I know you like music, you like to produce music. What do you consider a life well lived?
Yeah, good question. Happiness. I know that's, probably trite, but I think, whatever you're doing, if you can get happiness in your life, you're a success. I don't downplay the money, because money, allows you to pay your bills and take care of your family, but you need to do things that make you happy. I have been a musician for over 50 years. I'm a drummer. I did some recordings in the 60s at United Artists. I still write today. In fact, I've got several songs that are out on the streaming channels, that I've written and recorded, and it gives me happiness. I like doing it. Do I make a living at it? No. I make my living by helping people raise money and go public. But from a happiness standpoint, I like the music that I write, and I get out there, and it makes me feel good when I go on to YouTube and see how many people listen to my songs and comment on my songs. So again, a life well lived is happiness.
Yeah, I like that. Yeah, I'm always curious. We all in the financial aspect, we're in the business world, and I've seen too many people who have maybe lost the eye on the ball for happiness, or for a family life, and it's kind of being tied up in the money. So I like to have a well-rounded life, and which is why I like to ask this question.
Yeah, it's a very good question. And I bet you run into a lot of people that really can't answer the question, and that's sad because a lot of people don't know the good life. We're constantly inundated, with all the electronic devices we have now that, the good life is, are you listed on Forbes billionaire list? And people talk about Elon Musk, being $300 billion, and other people think, God, maybe that's, a life well lived is being a billionaire. Well, maybe it is. I don't know. Not in that class of, money people, but my whole thing is, am I happy? Yes. And I like my life. I've been around a long time. I like what I do, and I'm going to be around for a lot more.
Nice. I like that. Well, Michael, thank you so much for making the time for this very interesting discussion. Where can people connect with you, find you, and, take advantage of your services?
They could go to LinkedIn and look at my profile on LinkedIn. They could give me a call at 951-236-8473, or they could email me at mikebrette@gmail.com, and I reply to everything.
Awesome. We will also make sure to add those to the show notes. Thanks again for making the time. I know time is very precious, and have a lovely day.
You too. Thanks a lot. Bye.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.